Assalamu alaikum, this is Musawwir, an associate cost and management accountant. Today I am here with an accounting course that's particularly designed for the non-accountants. The title is the accounting for non-accountants. In this course I will try to gradually enhance your accounting skills from the very beginning till the complex concepts and the principles of the accounting. Let's start. Starting with the introduction to the accounting principles, before going into the detail, let us briefly discuss the aims and objectives of a business. Well, businesses are being operated for the purpose of generating profits, and these profits should not last for a particular period of time. Businesses are being operated to generate profits for a foreseeable future. So let's have a look how businesses are being managed and what are the structures of the business. Businesses are normally being managed by a team which is called the management, and the management is responsible to overlook the operations which are being paid by the investors, or what we call the shareholders, to regulate their business in the best interest of the shareholders. So you can see businesses are set up by the owners, and they invest the money and they let management to run their businesses, and they are accountable for the business decisions. And after a year, which is called the accounting year or a fiscal year, they are supposed to present the financial results to the real owners of the business. So in this framework, we will have a look into the basic accounting framework that is very much applicable to generate useful information, and that information is being presented to the shareholders. So accounting is basically the state of art which is used to compile, record, analyze, manipulate, and then report the useful business information and to present them to the stakeholders. Stakeholders may include the shareholders, employees, competitors, government agencies, regulators, and etc. Well, there are various kinds of businesses depending upon their size, depending upon their nature of operations. We have the sole trader. Sole trader is an individual trading alone in his own or her own name. This is recognized by a trading name. He or she is solely liable for all the business debts, but when the business is successful, can take all the profits. So guys, you see, the sole traders are the ones who operate a business by their own trading name, and they are liable for all debts or rewards upon their success, and liable for any loss that it may incur. The other type of business, we call it a partnership. Partnership is a group of minimum 2 people, normally up to 20 people, who together carry on a particular business with a view to making profits. We have then limited companies. Both in limited companies we have private limited company and a public limited company. Private limited company, is a legal entity, at least 2 shareholders, and their liability is limited to the amount they have been invested. Whereas the public limited company is a legal entity with limited shareholders liability, but unlike a private limited company, it can ask public to subscribe for their shares. So now we can understand what is the importance of accounting and what's the need of accounting education in the businesses. So as I discussed earlier, business must operate profitably. Well, it's right, and the financial statements or the accounting information which is gathered at the year end must present before the shareholders, must present before the real owners, so that the real owners will look on to their operations, whether the investment is doing well or the investment is not doing well. So the fundamentals of financial statements, you can see the financial statements are basically the total compiled picture of a business operation throughout a year. Financial statements normally consist of 5 key components. the statement of comprehensive income, statement of the financial position, statement of retained earnings, statement of changes in owner's equity, and the notes to the accounts. And we have the cash flow statements as well. So these 5 components make a financial statement. So we usually prepare financial statements in accordance with the worldwide accepted accounting principles, which we call the International Financial Reporting Standards. Well, let me tell you here, International Financial Reporting Standards are the accounting guidelines which are being set by an accounting regulatory body which we call IFAC, International Federation of Accountants. Under the IFAC guidelines, under the guidance, there is another body which is International Accounting Standard Board. This board issues various accounting standards for the countries, for the entities, and those entities are by law obliged to follow the accounting principles to prepare their financial statements. So as we talk about the stakeholders, the related parties, the interest parties in a company, we have government tax authorities of a country. Usually the government authorities or the regulators involve the tax authorities, the central depositories, the central banks, taxation regulators, and etc. We have suppliers, creditors. They will need to assure the viability of a business before accepting orders. If you prepare the financial statements and the financial statements are to be presented, and those are supposed to be published for the stakeholders, then the supplier will look on to the financial position whether the company is going to pay their credits on time or not. So this decision is based on the financial information that you prepare in accordance with the accounting principles. Then you have the customers, the debtors. Debtors usually buy goods or services from a company. Those buyers or those debtors may purchase those goods and services on cash or on credit. So once they are at debtors, they purchase services on credit. So you need to assess their financial viability while issuing the credits to the customers, whether the customers are later on having the ability to pay your debts or not. Then you have the employers. Employees are the one of the key stakeholders to a company, because the financial information you present is usually used by the employees to see the business financial status via unions or different professional bodies. And mostly we have in different markets that employees usually overlooks the financial statements to decide whether to join that particular group or not for a long-term purposes. Like they usually plan their careers in particular group as per their financial ability. So let's come to the objectives of accounting. The accounting has many objectives, including letting people and organizations know if they are making profits or if they are incurring loss, what their business is worth, and what transactions worth to them, and what transactions are significant materially, and how much cash they have, how much cash they need, how wealthy they are, how much they are owed, how much they owe to someone else. So this information they require so that they can keep a financial check on the things they do. However, the primary objective of an accounting is to provide useful information for the decision making, and this information is used internally as well as externally. Internally, this information is used to make informed decisions for the value optimization of the business so that they can operate and manage a great value chain within the processes as well, to minimize the cost, to optimize the value of a business. Externally, this information is used by the stakeholders, be they creditors, debtors, government agencies, employees, competitors, or any other they make use of this information to take relevant decisions about their businesses, because a business never operates in isolation. Every business operates in an interactive environment. Unless you provide fair and true and fair financial information to the market, the equal stakeholders of the market, they won't be able to decide and they won't be able to make informed decisions about your business. So you cannot operate in isolation. How is the relation of a people or a human resource with the business? That's very evident that every business requires certain amount of resources, be them in terms of cash, capital, human resource, technological resource, or any other. So what's the accounting, recording accounting data, how it is carried out, and what is the use of recording accounting data? As you know, businesses operate for a year, for a periods and periods, or a periods. So unless you record a particular amount of data, because you may have a lot of data, huge quantum of data all over the year, so the recording should be on time, so that you will have a proper check on the figures that you are going to present in your financial statements. You have the classification and summarizing. Once the data is being recorded, it's compiled, it's called the classification and the summarizing data. Then you would be able to compile this data, analyze this data to make sure the data's integrity is in place, to make sure the data is correctly presented, and then you communicate this information to the relevant parties. So the communication information, you need to evaluate whether which information is useful for you, which information has a substance, has an effect, or has a monetary or has a financial effect on your operations. So you need to communicate that information, compile in the form of financial statements to present to the stakeholders. Here come the accounting equation. As you know, every business has certain amount of assets, they have liabilities, they have capital in place, and they have revenues coming up, and they have profits returning year by year. So by adding up what the accounting records show belongs to the business and deducting they show the business owes. So over the year, the total amount of assets that a business own must be equating with the total amount of liabilities the business owes to the outsiders, as well as the amount that's been capitalized over the years. So it becomes capital is equal to assets and liabilities. Capital is equal to assets and liabilities. Here the capital is what you have in your business, the amount the investors have invested in the business, which is in the form of assets probably, and the amount which the investor owe to the outsider parties. So you have the capital. The net amount a business retains in itself is the capital, whereas the assets is the amount of resource that's been employed in business and has a useful life, maybe a year or more than a year, and do have a capability to generate profits over the period of time. Whereas liability is the amount of sacrifice an entity is to make in the future, and the current benefits, of course. So again, assets are of two types: current assets, non-current assets. Similarly, liabilities are of two types as well: current liabilities, non-current liabilities. So we will go into detail in later chapter, but for now, capital is equal to assets minus liabilities. This is what we call accounting equation, and how we will see how the accounting equation is being impacted by each and every transaction a business is making over the year. So let's learn how the particular transaction, or how a single transaction impacts the financial position of a business. For that, let's assume a scenario here. On 1st May, 25, Blake started a business, deposited $60,000 in a bank account opened specifically for the business. The statement of financial position would be as below. So you can see the financial position over here. So B. Black, the financial position as of the date, you can see he invested $60,000 in his business for the cash. So you see the assets like cash at bank is 60,000 at the year end at the particular date, whereas the owner's equity, because the amount which is being deposited into the bank account by the Black, which is the owner of the company. So the impact of financial position by this transaction is you have asset 60,000 as well as you have the capital 60,000. So the balancing equation, so the accounting equation is balanced because you have capital 60,000 on the left hand side of the equation and you have 60,000 assets on the right hand side of the equation. So the equation is being is equal.